opportunities, financing opportunities for MSME exporters, and this in organized in association with ICICI Bank. So ICICI Bank has been supporting the council in organizing various events on various matters of interest to exporters. So we are very grateful to them for having, collaborated with the council. Now, this one today is a particularly important one, which looks at financing opportunities for MSME exporters. As you're all aware, MSMEs are the backbone of India's export system, contributing significantly to employment generation, innovation, and foreign exchange earnings. I mean, that is, we are all well known, almost 65 to 70%, if not more, of the export takes place from the MSME units. However, access to timely and cost-effective finance continues to be one of the most critical challenges faced by exporters. And in fact, every time you have a discussion with the MSMEs, they have some issue or the other concerning the credit availability and various other issues related to that. Now, understanding the various financing options, government support schemes, banking facilities, and recent regulatory developments is essential for every exporter to remain competitive in the global marketplace. I mean, that is well known to all of us. Now, today's webinar particularly has been curated to provide practical insights of financing options for MSME. So let's see, I mean, all of us should learn from what are the practical ways of dealing with credit issues. During this session, the faculty will cover following areas: the latest financial schemes for MSME exporters, pre-shipment and post-shipment finance, export bill financing under letters of credit, the use of factoring and letters of credit, this is very important, the management of credit risks, that again becomes an important issue, interest subvention scheme, all of us are aware of it, but many of us are not receiving it in time. There may be issues in terms of communications or understanding, and of course the latest development in export finance. So it's always good to be really clued into the developments which are taking place in and around us, especially when it's relating to export finance. And in a rapidly changing world, a lot of initiatives you would have seen the government is taking. Some of it we are able to quickly understand. Some of it takes time for us to comprehend. So we will conclude the session, of course, with a dedicated Q&A segment, which I encourage all of you to participate in this, because ultimately the objective of all these things is to go back with some clearer understanding of the subject matter, so that all of us are definitely equipped better to deal with our challenges that we may face as we go forward in our businesses. Now, before we begin the session, let me shortly introduce our faculty today, Mr. Gaurang Vasavada. He is an ex-banker. You can see him on the screen, with over 35 years of rich experience in international trade, finance, and foreign exchange. During his distinguished banking career, he held several important positions, including chief dealer in the Forex and the head of the international division at Bank of Rajasthan, and also served in various roles with ICICI Bank, including branch head, compliance manager, subject matter expert in trade. Currently, he is actively involved in training and advising corporates on trade, Forex, FEMA, and RBI-related matters, and also associated with institutions like IIBF and FIDI as a resource person and faculty. He is also assisting us in our efforts to have in the advanced certificate program in international trade, which you can see at the back. It's announced, and he's one of our faculty who has been kind enough to come. He stays in Ahmedabad, but he takes time out and came and spent a whole day talking to our students who have enrolled in this program. So we will encourage all of you also to look at this program, because this will equip you with some kind of knowledge of what exactly is happening across the global and international trade, and also in the Indian trade ecosystem. So I think I once again welcome all of you and wish every one of you a very good session. I please request you all to stay muted during the presentation, and after that raise your hands, put your questions in the chat box, and then interact, because the idea here is to go back with a better understanding of the situation. When we attended, we came with a lot of views or did not understand the subject matter very clearly. But when we leave this session, it's about an hour session, which we hope we would have answered many of your queries. Even if they are not unanswered, you're free to write to us, and so that we can explain, get it even I give you an explanation in writing as well. So a clarity or a clarification if you want. So with these few words, may I now hand over the floor to Mr. Gaurang Vasavada, who's our expert, and I think he's joining us from Ahmedabad. Right, sir?
Yes, sir. Yes, sir.
Thank you, sir. Thank you for coming in.
Thank you. Thank you, sir.
Go ahead.
So good afternoon to you all. Thank you, Dr. Rajgopal, for the introduction, and thank you, TEXPROCIL and ICHI for bringing me here. Good afternoon, Vare sir. So very rightly said, sir, very important topic on financing of exporters. I'll start my presentation. You may please put your queries or questions in the chat, but I will take towards the end or by the raise of hand. I just start my presentation from there. Okay, here we go. Topic is financing opportunities for MSME export. Now, all differently colored. Opportunities are, of course, opportunities. MSME by itself has a big role to play in our country's development, employment, production, growth, GDP, etc. And exporters per se, we want exports. The country is in higher needs of export to grow exports. So exporters by itself, they are important for the country. And how do we grow without finance? Finance is the backbone. I will have some little capital, I can start the business, but to run the business, I will require support. We'll try to maybe see that what all opportunities are there. I have tried to bring in some of the aspects where people call and ask some of the questions, so that I'll try to clarify here, so that those who are on this session, they will be clarified of something which can happen to them or which they may face subsequently. Let me start with something where in the Union Budget 25, the thrust on MSME was reiterated. It was there. It is not there that it was not there. It was there, but it was reiterated that thrust on MSME has to be there. And government at that time said that we will be strengthening those measures and bringing significant policy changes where we want to strengthen the overall MSME sector. Now, two things which I can see that why the thrust on MSME is: one, that MSME is something which will create India or make India as a manufacturing hub. And another where MSME provides a lot of employment opportunities, not only self-employment, but employment opportunities also. So that are two things which I think government would have in mind, and because of that, there was a lot of thrust given in that 2025 budget itself. And it was also said that it is not only that what thrust by way of technological upgrades, growth incentives, and better credit access. So where various ways and means of credit access were also required. It was announced that around 5.7 crore MSMEs were there in the country. They were contributing to around 36% of the manufacturing sector, roughly 50% of the export. This was over around 45 to 50 only. The contribution to GDP was 30%. Now the contribution has to go up. I think the contribution to manufacturing sector would go up to 50% by next 2 years or so, and the contribution to export sector would cross 50% by then. So as of MSME's website, as of yesterday, 8.91 Udyam registrations are there. You see, roughly 5.7 crores as of 31st of March, and that figure was there in the budget. So maybe that could have been January, February. And an employment of around 40 crore people as of yesterday. Now, this gives a picture that why MSME is important to the country. And with all these, kudos to MSMEs for maybe bringing in and working overtime to bring in new technology, to maybe to make in India, to export, and to provide a lot of employment opportunity within the country. The definition of MSME was changed. Micro was investment of 1 crore and turnover of 5 crore, which was changed to 2.5 crores and turnover of 10 crores. The small was 10 crores and 50 crores, which was made to 25 crores or 100 crores. So investment in plant and machinery. This does not include land. So plant and machinery 25 crores and turnover of 100 crores. And medium from 50 crore of investment to 250 crore of turnover, which has gone to 125 crore of plant and machinery and 500 crores of turnover. Now, this very clearly shows the thrust on turnover on 2x and investment in 2.5x is the upgradation, renovation, bringing in new plants, better investment in plant and machinery, and all those technological changes which we want to put it into the MSME sectors to become a large producer for the world. The announcement of various policies relating to credit. Credit Guarantee Fund for Exporters. There is a National Credit Guarantee Trustee Company Limited, NCGTC, where in 2025 they announced a financing tool for exporters. Now, this is purely on the putting the thrust on the manufacturing, increasing the manufacturing capabilities and capacity. Technology also. What does it say? Support for additional working capital needs through banks, FI, and NBFCs. Now, working capital is available. The sanctions or funds are released by banks, FI, and NBFCs, but the support or the guarantee support is given by LCT. 1912, this is this latest one which was announced last, where people were already having the working capital loans and limits sanctioned through various agencies, banks, NBFCs. But because of the cyclical issues in the world, the turnaround was not there. They were stuck with stock. Orders were cancelled. So they said maximum 50 crore rupees, that being a 20% of the sanctioned working capital facility, could be guaranteed by this under this scheme. So if a bank has got if a company has got a limit of 10 crore rupees and they need more funds, but the bank or NBFC is reluctant to give those limits because of the various issues, cyclical issues also could be, global issues could be, then the additional 20% can be granted by the bank subject to the guarantee being released by NCT. So it becomes a risk-free, maybe additional capital released by the banks, and it gives us the additional funds to the exporter. What is required? Udyam registration was required, 100. So somebody enjoying limit already with the bank will already have an Udyam registration because you have interest benefits, etc. on the MSME. So nobody would, no MSME unit without Udyam registration will have a limit with the bank. 100% of amount of default. So bank was only releasing the funds. And the interest rate cap was also given. You cannot charge more than 10% and 14% for NBFCs. And the target 20,000 crores, the target was there. This was the latest one on 1911. Additional support for additional requirement to exporters during those times of crisis, because we started facing this global hiccups, particularly during that time, and that was announced by the government. There is one scheme, SEOE, Support for Emerging Export Opportunities 2026, announced by DGFT on 22nd of April 26 under the Export Promotion Mission, Niryat Protsahan, to facilitate enhanced global trade connectivity and liquidity in underserved markets by enhancing confidence in trade settlements, strengthening the capacity of banks to support constrained cross-border transactions, and fostering partnership between Indian banks and local banks abroad. Now, there are several markets we have never ventured. Several of the markets. Why we have never ventured? Because of the, maybe our banks do not have license there, they do not have the local connections there. The weakness of those financial systems as well as the countries, because of that, we do not accept the LCs issued by them or guarantees issued by them. So how to go there? Banks are reluctant, banks will take their own judgmental call. So how to go there and how to accept their LCs? So Exim Bank has been put in between, because Exim Bank's work is global, maybe looking around for global partners, etc. So what they have said that if there is a risk, somebody's mic is open, please check please. So wherever there is a risk and banks are reluctant to accept or confirm the LC or negotiate the documents under LC, their Exim Bank could come in between and give a guarantee up to 100% of the value. And there, on a non-recourse basis, if a bank is agreeable to add a confirmation to a LC, where even if they do not have a link with that bank or a country, because the confirmation is always done on the credit lines which are sanctioned by a bank in India to a bank abroad which has issued the LC. And the premiums were so low which Exim Bank would charge based on the risk category of the country and the profiling of that institution. So there's a huge chart given there. 0.5% to 2.5%. Now, normally our confirmation charges, bank would charge 2.5% also. This is a reiteration. So the commission is to be paid to Exim Bank, and for that they will give a comfort to your bank to add guarantee. Suppose there is some African country where the bank says, sir, we don't add guarantees. Why? Because of the foreign exchange crisis, or because of the weakness of the bank which has issued the LC. Maybe the Exim Bank would give a comfort here by charging certain commissions. Now, this is particularly focused on those markets. We are not saying Sri Lanka, Bangladesh, or UK, Europe, etc. These are those markets which are where a comfort is not there. One is because of the country, another because of the financial system. Mutual Credit Guarantee Scheme or MSME in manufacturing sector, announced along with the budget in 2025. This is primarily focused on capital expenditure, plant and machinery, to enable the existing MSME as well as the new MSME to adopt the newer technology, newer machines, or increase the manufacturing capabilities. Capital expenditure relating to plant and machinery. How does this work? Udyam registration. The finance or the term loan relating to plant and machinery sanctioned by the banks and non-banks, NBFCs, etc. Finance is sanctioned by them. The guarantee cover is given by the NCGTs. What is the guarantee? In case of default, 75% of the value of loan, the cost of machinery, will be paid by NCGTC to the financing institution or bank. Total amount was 50 crore rupees per IC or per borrower, and a flat fees was there. First year no fees, like in term loan. 8 years after moratorium of 2 years, so total 10 years was there. First 3 years, 1.5% guarantee fees, and thereafter 1%. They create a pool, and if there is any shortfall, government will get it. Now, this scheme, the target for 4 years, 25 to 29, was 7 lakh crores. The focus is on make in India, make for the world. Create the capabilities to manufacture newer products, globally acceptable products, by way of infusing new plant and machinery, new technology, etc., and make in India, make for the world. Increase contribution of MSME to GDP. So we thought it was 36%. We want this to go up, and then resultantly it will also increase the employment opportunities in the MSME. Now, this scheme in 26 budget, again, it got certain improvements. What does it say? The threshold of 50 crores was increased to 100 crores. And the minimum cost of plant and machinery, which was earlier required that 75% would be there, it was reduced to 60%. So overall, maybe a project is there. Earlier it was required that 75% of the project cost should be plant and machinery. Now they said that overall project cost, if it is 100 crores, only 60 crores plant and machinery would do. Special provisions for existing exposure the existing people in any of the industry, textile, wovens, or any of the industries, would require refurbishing, putting up new plants, technologies, etc. So there they have said, earlier this was not there, there they have said that we would give a guarantee of 20 crores up to 75% of the guarantee, provided your total turnover for last 3 years, at least 25% exports is there. So what the aim is that while we manufacture for the world, not for only for our country. Now, earlier definition was only looked after whether you are an exporter or non-exporter, everybody would get it. But here the specific thrust has been given for exporters to renew or maybe get their new machineries or new systems in place, adopt new technology to manufacture for the world. The next one is Credit Guarantee Trust Fund for Micro and Small Enterprises. We talked about the newer schemes. We talked about the capital expenditure or plant and machine related guarantee fund. Now, this guarantee fund is for working capital, collateral free working capital. For whom? Micro and small enterprises. Now, 4 or 5 years back, this limit was only 2 crores, then increased to 5 crores, and then increased to 10 crores. What does it say? Micro and small enterprises, including service enterprises, are eligible for collateral-free loans, working capital, up to 10 crores. There is a guarantee which is to be paid to this CGTMSE corporation, 0.37% to 1.8%, and hybrid lending is offered. This means that if I am able to get, my project is good, but I don't have a collateral. And because of that project, the bank is agreeable to release me the funds. But they say that without collateral, we are not comfortable. Because banks will have their own norms. We'll see how banks have their norms. So banks can always resort to this CGTMSE guarantee, sanction the limits first, then go to CGTMSE and get that approval and then release the funds to you. So they get a cover from them. So collateral is not there, but the comfort is there from CGTMSE corporation. We just saw small enterprises, the plant and machinery requirement investment is 25 crores and turnover is 10 crores. Now a turnover of 10 crores, if somebody, maybe 100 crores, so somebody getting a limit of 10 crores can always have at least 50, 60, 70 crores of turnover. So that is always possible there. How does this get sanctioned? So an exporter or a borrower who is under small and medium enterprises needs to approach the member lending institution. Now, member lending institution could be bank or a NBFC or a MFI. And then you have to apply the bank. The norms of the bank will have to be complied. Only one eye is to be closed. There is no collateral. Other than that, all your balance sheet requirement, your capital requirement, your project requirement, your profitability requirement, or past track record requirement, everything will be happening. And once they sanction, they will apply to the CGTMSE corporation for guarantee coverage. And once the CGTMSE corporation confirms that okay, this proposal is okay, because they will have to send the application form and the sanction letter, which is subject to CGTMSE, both to the corporation. And once they confirm that okay, we are comfortable, you have done the due diligence, etc., whatever is required, and sanctioned the limit, we are comfortable with this proposal and we are extending our guarantee. Once that guarantee cover is extended and that guarantee cover is extended to that institution, bank or MFI or an NBFC, then in that case, next step would be that bank will release the loan, take the guarantee fees, and the guarantee fees has to go to CGTMSE. For CGTMSE, there are two tracks given. For banks, the limit is 10 crores, and for NBFCs, the maximum limit is 5 crores. I was just going through the website of CGTMSE. There are large number of banks and large number of NBFCs which are registered there. Collateral free loans. March 26, 1.42 crores guarantees, number of guarantees were there, which were covering a total value of 13,67,418 crore rupees. 13 lakh crore rupiah for 1.42 crore guarantees. At times, when an exporter or when a borrower goes to a bank branch, I'm telling you this from the practical things which come into force. The person sitting in the branch may not know about CGTMSE. And then the response is, sir, हमारे यहाँ नहीं है. So whenever I want to borrow from a bank, I have to connect with the correct person. Each bank branch may not have a person who is from the credit side, loan department. Either you have to talk to the branch manager who would be or who is expected to know all the schemes of the bank, or you have to talk to somebody in the loan department who knows that whether and under what conditions we are allowing under CGTMS. Some people say, sir, private sector banks don't give. No, it is not like that. They are listed there in the CGS1. All banks, public sector also there. In some of the seminars, people say, sir, I have a message from 3-4 days from somebody from South who says, sir, I had approached so-and-so bank and they have said, we don't have this scheme. Can you please confirm? It is not that. The correct person is not there. If I do not know anything, then I will say no. This is simple for us. So you have to connect with the correct person. Try to find out maybe ifs or buts or conditions are there. Some of the banks say, sir, we want some fast track report. So the new people who want to start a business now might face certain problem or might face certain new questions or requirements. But the scheme is not there, is not correct. Some of the other means, before I move to what you call bank finance, let's see. For raw material purchase, I may get the LC route or use the LC route also. Domestic purchase of LC, domestic purchase of raw material, or domestic purchase of or imported goods, both, where I may not require funds now. The funds may be required, say, at 90 days. My supplier of maybe the cotton or supplier of yarn to a textile unit agrees that under LC I will give you 90 days credit. What I am doing, I am not making the payment now at site or upfront, but I am committing through my bank that I will pay, my bank will pay at 90 days. When the bank commits, the supplier agrees. What I am doing, deferment of my payables. Instead of using my working capital at maybe 9, 10, 11% of interest rate, I am using this channel and reducing my cost also by maybe just paying 1.5-2% only as a charges for LC. Then there is a supply chain finance facility for various suppliers of goods to other companies, where the purchases of companies, once they accept, the bills are discounted by the financing institutions under bids. So banks have got supply chain limit sanction to larger corporations. So suppose maybe let us take an example, say maybe Reliance is buying yarn. Then if a bank is sanctioned a limit to Reliance, their suppliers of yarn can get the bills discounted. So maybe Reliance says we will pay on 90 days, the bank will upfront discount those bills. So discounting under the supply chain finance facility. Financing of bills drawn by suppliers in trades, trade receivable discounting system. This is an RBI approved system where you lodge an invoice that is maybe that approval is given by the party on whom the invoice is raised, and then there is a bidding process for that. We'll see how it works. RBI regulated digital platform in India enables MSME to convert their trade receivables invoices into cash immediately, addressing delayed payment from large corporates. So it is mandatory now. In many of the segments, it is mandatory that it should be done. An online exchange for invoice financing without collateral and enhancing it. No collateral required. Buyer says, I will give you at 90 days. Seller gets the money immediately through trade system. Companies with a turnover of over 250 crores are mandated to register on trade. So those buyers who are having a turnover of 250 crore plus, there is a mandate that they must register on trades only. If they register on trade, their suppliers can always draw invoices, supply goods, draw invoices, and get it discounted through trades. It is a reverse factoring system. The seller uploads the invoice, the buyer accepts it, and then multiple financiers bid on the invoice. The seller selects the best bids and receives funds quickly, often T+1 or bank loan T+1. Process flow says you upload your invoice. I hope many of you would be using this for domestic supplies. MSME sellers uploads the invoice bill of exchange. That is the factoring unit is there. All the exchanges. 3 exchanges are there. M1 exchange, etc. The buyer accepts. You will get a trigger that one invoice has been raised on you. Then the financer, several banks would bid 8%, 9%, 10%, 11%, whatever the rate is. And the seller then will select the best bid for him. Financer pays the funds minus his fees, etc., to the seller on T+1 day. On settlement, the buyer has to pay to the financer because he cannot default. And this has overall lowered the cost to 7 to 10%. I was talking to one of the companies which is buying goods. So he says, sir, we get around 8.5 to 9%, or maybe sometimes 9.5%. Otherwise, the limit could be at 11%. Now, going forward, what we are looking at? Trades for foreign bill discounting. What we call ITFS, International Trade Financing Services. This is as per my knowledge, this is not yet operative. This is a non-LC, this is beyond factoring. We will discuss factoring in the end, but this is beyond factoring. Access to global finance for bills drawn on foreign buyers, easing of liquidity, cash flow management. Possibility to offer. Now, what happens every time the exporter wants upfront fees? I'll just pause for it.
Gaurang ji, you are not audible.
Sir, just 1 second, sir.
Oh, okay.
Okay, sorry. What normally is that we want upfront funds and the buyer always would want credit of 90 days, 180 days, etc. So when you have a non-LC segment where such systems come in place, you are always comfortable and you can offer credit terms. Now you are at par with others across the world where you can offer credit terms and compete with those who are supplying goods from, say, maybe Taiwan or Vietnam, etc. This is also without recourse. The entire process is digitized. So no physical documentation, etc. And discount rates would always be linked to SOFR plus markup of maybe 2.5%, 3%, 3.5%. So the overall cost in dollar terms goes to around less than 6% in my view. Now we're coming to the segment where how do I get the finance from the banking system? Let us first understand that when we talk of export finance, we must understand that we are taking finance on something which has to be known or which has to be recognized as export. So the law FEMA Act describes export as taking out of India to a place outside India any goods or providing of services from India to any person. This means that if I draw a commercial invoice and send the goods at commercial terms abroad, then it will be deemed as export. If I send samples or if I send something as gratia, as a gift, etc., it is not export. We call it export of gift, but ultimately it is gift. It is export, but if it is gift, so no commercials are there. Commercial invoice. Now, when I have a commercial invoice or if I intend to draw a commercial invoice, then it is categorized as export, and then I am entitled to raise export finance from the system within the definitions given by us. Until 1992, we had only rupee financing. From 1992, we had this foreign currency finances where now what we call PCFC drawing. It started in. Export is defined. RBI has categorized export finance as a separate financing window. It is not a part. So what we say, it is a financing window for cross-border trade, but not similar to domestic trade. Domestic finance. Domestic financing, we have different window. Because it has been crafted to take care of the specific needs of exporter. Somebody who is a global player, not similar to domestic credit. Financing of production, procurement of exportable goods. Finance is targeted to promote exports and it is available to DTA, SEZ and deemed export. How this is different from the domestic finance. In a domestic finance, I get cash credit or overdraft limit sanction. I get a checkbook. Separate CC account is there, separate checkbook is there. I also have a online logging right. I can do a RTGS online. I have a limit of 1 crore. I am eligible to write 1 crore check today itself. I have a sanction letter, limit is in place. I get a message, your limit is in place. I can write 1 crore check. And interest I can pay on monthly basis. I can deposit, I can draw, I can deposit, I can draw. Anything. Flexible limit account. 1 crore is at my disposal. Whenever I want, I can draw. Whenever I want, I can deposit back. But in export finance, it is not like that. Export finance, there is no account like 1 crore, 5 crore. I only get a notice that I have an account. I have a limit of 5 crore or 1 crore, but I don't get a checkbook or RTGS. I cannot draw. I have to give the proof that I want to draw money from that 1 crore limit by providing a copy of the order or approaching the bank whenever I want the money. Approaching means whenever I have to approach, whenever I want to draw from that limit, I have to approach the bank or I have to connect with the bank. Here I can write the check or I can do a RTGS sitting from my office or home. But here I have to submit my request, every drawing, along with a copy of order to show the intention that I have an order, I want 20 lakhs out of this 1 crore. Tomorrow again I get a new order, I want 10 crores out of it. Every time I have to touch base the bank. Transaction level touch base. When the money comes in, the limit goes down. Now every drawing, the bank will debit that 1 crore limit, but they will also create a another account for every drawing. So we'll see how it works. So not similar to domestic credit. This is a transaction banking, what we call. Every time I have to approach the bank, I have to touch base the bank. Till very recently, there was an RBI circular of 2015, which was the everything for export finance. There's a separate circular on export credit and customer service. Very recently, or in the recent past, in November 25, RBI has consolidated all the guidelines and brought everything under one master direction, which is called Reserve Bank of India Commercial Banks Credit Facilities Direction. Now everything is there. When RBI carved this separately, what are the expectations from banks for granting it? Export is a thrust area. Export is a priority area. So they said timely availability of credit should be there. If I am having a limit or if I do not have a limit and I have an order, banks must process the limit related process or limit related request as early as possible so that my order does not get frustrated. And the cost should be affordable. And normally, in my view, affordable means that if bank is charging 11% for CC, bank would charge 10% for export finance. To meet the genuine credit requirement of the export sector, any order should not frustrate for want of funds. Bank should consider it provided other parameters are meeting their requirement. And the flexible approach on debt equity ratio margin security. So it should not happen that I have an order, but I say, sir, I don't have capital also. I cannot put any money. Then banks may not do it. So other parameters will have to be done. Some flexibility here. And the quantum of finance should be dependent upon the expected turnover, capacity, capability, orders in hand, and expected orders. So the capability goes here. Bank would judge whether I have an experience in doing exports, whether I have an experience doing some textiles, etc. And for simplification of procedures, assessment should be need-based, not directly linked to the collateral being given. So we have non-collateral related. So one more question comes up. Sir, whether CGT MSE can be taken for export finance? Why not? Yes. CGT MSE has not said what color of limit you have to give. Even for non-funded also I prefer. I say it could be given. Then line of credit. Line of credit means that you can do a sanction for a 3-year period based on the bank's internal guidelines, credit call, etc. Interchangeably between pre-shipment and post-shipment. Sometimes I have more orders, but shipments are delayed. So I will require more money in hand. Sometimes I have already made the shipment, so I do not require money here, but against the bills. And for those commodities where I need to stock for some time and then sell for some time, peak and non-peak events could be. And very indicatively, in the 2015 circular, these limits are given for fresh limits 45 days, renewal 30 days, and off. Now this is gone. Why I have kept it here? Because in this time when we all work online, a bank which will takes 15 days to sanction, nobody would go to them. It is that people are sanctioning in 3 days, ad hocs in 3 days, renewals in 5 days. If you complete the paperwork, then you get a new sanction also in 5, 7, 10 days. Bank is after the exporter to get good people to take finance from them. Then there are various aspects relating to running account, value date. We will all cover all this maybe later on. There is also a concept of gold card, where RBI said that you may give a gold card or issue a gold card to good exporters who have got a good track record, no defaults, where you could allow additional benefits to them. Maybe additional credit line. 1 crore is sanctioned, but there is a standby limit of 20 lakhs. You can draw this 20 lakhs 2 times in a year or 3 times in a year. Additional sanction is there. So you are not, whenever you require additional funds, you are not required to go to the sanctioning authority. And concession in charges, etc. Interest stipulations, all the guidelines have now made it free to the banks to fix the, the interest rate based on the risk parameters, but it is to be linked to certain benchmark. Currently, rupee financing is being done at repo rate or treasury bill rate. Banks, you can get the finance sanctioned as a working capital limit. For domestic, we get CCOD, even bill financing domestic is also there. On the export side, we get export finance, pre and post shipment finance. Then tenor-based acquisition of assets. Assets means largely the machine, plant, etc. And non-fund based limit by way of letter of credit, bank guarantee, SBLCs, both for domestic requirement and import requirement. Theoretically, when the banks consider the proposal, they go by 5 principles of lending. This is from the books or the guidelines which were issued or the maybe committees set up by RBI to understand and think of the better lending propositions, etc. Character is the credit history, whether you have defaulted earlier in past or not. And our CIBIL score is one which is even a default of or a delay of payment of our credit card bills by the directors, partners, promoters, etc. could weaken that character of that company itself. So the discipline for repayment of the money which is due to some other institution is very necessary for all the people who are involved in the company. The capacity means ability to repay. You are borrowing the money from the bank. The money which the bank gives is not the bank's money, it is the public money by way of deposits they are collecting or maybe the borrowed money. They will want this back to repay to those depositors. So the ability to repay. So what is the backup plan? If your bill gets stuck abroad, what is the backup plan? Whether you have taken ECGC, if there is a fire, then how do you get it? Whether you are doing insurance, if you go into loss, then how do you cover it? Whether you are financially sound to repay the loans, etc. Capital is what net worth is there. What is your contribution in the company? How much stake you are putting? Normally, 1/4, 1/3. Different parameters could be there, but 1/4 is there. Collateral security. Collateral security is something where people would say, sir, why they ask? Collateral security is just the commitment which I can show to the bank that I am committed to the business and I will not back out. I will not put you at loss. So I am giving my house, my factory, my office as a security. Nobody begins or starts a business by thinking that I will sell my house or I will sell my house and repay the amount due to the bank. Nobody starts that business. It is only a comfort which I am providing. Even bank is not keen that for a business entity, they should be required to sell a property. That is a separate mortgage loan scheme for the banks. If you want money, you can take a mortgage loan. Then it is not a business loan. And the conditions. If you are borrowing for exports, then what are the external conditions, how the economy is going, how the industry is going, the interest rate scenarios, the overseas market, the commodity prices. Suppose you are in certain commodity where prices fluctuate like anything. So the prices would depend on the conditions and margins. Everything of this would be there in the bank's credit policy. Bank will have their own credit policy. The new guideline also say that major things, including export finance related aspects, should be covered in the credit. Competition of limits, various methods are used by the bank. What best suits you, but generally, maybe straight line method is that if you project a turnover, say of 1 crore rupees in the next year, 20% of the projected turnover, that is 20 lakhs limit, can be drawn anytime. But for export, this is not feasible. My buyer sometimes would give me a side bill. Sometimes the buyer will say 60 days credit. Sometimes the buyer will say 180 days credit. With 20% limit, I will not be able to meet both ends. So maybe for exports, I will have to work out on a projected balance sheet, and NPBA for operating cycle is more. Banks ask for security. The prime security is the goods which you have procured for the bank finance or your bill against which is financed on. That is the prime security. And collateral we have already discussed to provide comfort to the bank. Now, ECGC guarantee or a credit guarantee by any credit guarantee agency is an additional security. Because if it is covered, say, up to 80%, 80% money bank will get, then 20% only problem is there. But ECGC or any other credit guarantee is risk sharing guarantee. Proportionate risk is to be borne by both bank and the ECGC. And ECGC could be bank allowed ECGC, whole turnover policy taken by the bank, or it could be a policy taken by the exporter on the bills drawn on the foreign buyer. When limits are computed, there could be various conditions. Sublimits for domestic and non-domestic, pre-shipment, post-shipment, etc. We'll see, I have a chart there. Then margin stipulation. What is your stake? So if you are buying goods for 100 rupees, bank will not give 100. It will say we'll give only 70. 30 rupees you bring in as from your capital or own money. And then domestic versus what you call export business, and within the export pre-shipment, post-shipment interchangeability could be built in there. 20% of the money interchangeable between various segments. There is a saying that all eggs should not be put in one basket. So banks may stipulate that the entire limit should not be used for doing export to only one party. So they may say minimum 4, minimum 3, etc. Because to make you disperse your business. This is the ideal way that even we should think. We should not do business only with one buyer. Tomorrow something happens, our 100% business goes down. We'll not be able to come up. And if you are exporting to your sister concerns or supplying goods to your sister concerns or maybe related concerns, then also there could be limits. Banks may also prescribe limits for country exposure and conditions relating to ECGC cover. Just given an example on how limits could be structured. A bank has given a total exposure of 10 crores to a company. The company has both, maybe almost 50% of domestic and 50% of export. So they have said, CC, you can draw up to 5 crore, but you can also draw up to 6 crore in post-shipment. Now, total is 11. But either you draw, if you have drawn 5 crore in CC, then you will be able to draw only 5 crore in pre-shipment, post-shipment. Total. Out of this 6 crore, suppose I say that, okay, sir, I want to take more of export finance because my CC is at 10% and my export finance is at 9%. And I also get subvention there. So I will take 6 crores in post-shipment, pre-shipment and 4 crores in CC. So out of this 6 crores in pre-shipment, post-shipment, I am allowed only pre-shipment up to 4 crores. But post-shipment, I can go up to 6 crores because it's a bill, because there's a concrete proof, shipping bill, BL, etc. that shipment has been made. Now, if they are side bill, the turnaround is better. So entire limit is available for site, but for usance turnaround is delayed 90 days, 60 days, etc. So there is a restriction of 4 crores only. And then out of this 10 crores, you can also draw LCBG for up to 2 crores. So if I am drawing LCBG of 2 crores, then my other limits, CC pre-shipment would only be available for 8 crores. And ideally, forward contract limit is also sanctioned. Taking 10% risk. 1 crore is blocked for that. It means that I can go up to 10 crores of forward contract booking. Now, somebody who has an export limit of 6 crore, maybe having a total export turnover of 20, 25, 30 crores also, or 40 crores also, for him 10 crore forward contract limit should be okay. But if I have drawn 2 crores under LC, 1 crore under forward contract, then only 7 crores is remaining with me to avail as cash, pre-shipment or cash credit. That needs to be said. So various permutation combinations can be there. I was going through a sanction by a large bank just today morning. Variety of things have been given there, including the restrictions on EPC. EPC is available only for 3 months. Post-shipment is available for 3 months, but 50% of the value of post-shipment is available up to 6 months, depending on your drawings, how you are got your orders, etc. Variety of combinations are there. CGTMSE we also saw. I just want to make one point clear here. Hybrid lending under CGTMSE. Hybrid lending means that if I have a limit, suppose I have a limit here of 10 crore, where collaterally bank has agreed to give me, maybe some collateral is there, 10 crore is there, 5 crore is there, whatever bank has agreed to give me. But now bank says we are not able to increase because beyond this we cannot go. But I want additional money, 2 crores extra. I can always approach the bank, you sanction me 2 crore new limit and take it under CGTMSE. What does it mean? Hybrid. 10 crores under limit based, collateral based, and 2 crores under guarantee based. I will be paying guarantee fees on 2 crores to CGTMSE. 10 crores will run like that. Both the accounts will run parallel. 10 crores separate account, 2 crores separate account. Hybrid lending. Let us just go quickly through some of the aspects relating to export finance from banking system. In each of the points, if you miss out something, it adds to your cost, it adds to your non-compliance, and it adds to your default for the account as a whole. Pre-shipment finance and post-shipment finance, export finance is given in two areas. One is prior to shipment and after shipment. And both will have the different nomenclatures, different terms and conditions. Pre-shipment could be fund-based and non-fund-based. I draw money, send an advance to my supplier. The supplier, after receipt of advance in 30 days, he supplies raw material to me. I am paying interest from day one. Day one, before receipt of goods, also I am paying interest for 30 days because it is a 30 days advance they need. But suppose I am able to get my bank issue an LC in their favor, even 30 days in advance. And then I can ask them, sir, the LC is there, now you give me credit period of 90 days. So what happens? Instead of paying interest, I pay commission for 120 days, approximately 30 days in advance and 90 days credit period. I am saving on that interest for that 120 days. I am only paying commission at say around 2% per annum or so for 120 days. And the difference of interest would be roughly 7%, 9% minus 2%. Even if subvention is there, then also 7 minus 2. I am saving interest at around 5%, 4.5% straight away for 120 days. Once the bank receives the document, they will give a confirmation to pay at 90 days, and at 90 days they can debit your packing grade account and release it because it is sub-limit within that. We saw out of the total limit, 2 crores were given in the example for LC. Each drawing I have to submit a confirmed order or letter of credit, and for which, because each order will have a different shipment date. Once it has a different shipment date, then in that case, different due dates will be there. So within the maybe 10 crore limit is there. I am drawing packing credit for 4 crore. Within 4 crores, there could be some 10 different draws, 30 lakhs, 20 lakhs, 50 lakhs, etc. And in each of the draw, the due date will be different. So suppose first order I have a shipment to be done by 31st of July. And we count 21 days for submission of order, or submission of bill. So 31st of July plus 21 days, 21st of August will be the due date for first drawing. The second one says 30th September, so 30th September plus 21 days, 31st of October, and like that. These due dates will be different for all. So within one 4 crore limit, different sub accounts or notional accounts will be opened. And these are important for me because if I do not watch this due date, from next day I start paying penal interest of around 2%. Normal 9% now, from tomorrow it is 11. Maybe at 9% I am eligible for interest subvention of 2.75. But from tomorrow that also stops. So what is the catch here? If I am not able to do the shipment within those given due dates, then based on the correspondence exchange with the buyer, maybe there is a because it is as good as extension of order. Before 31st of July, I am not able to do the shipment. I can always discuss with my buyer, get the due date extended in the order itself, submit to the bank before 31st of July, and get the due date of the packing rate extended subject to sanction limits. Packing grade is always given on FOB value. So freight and insurance is not covered here. So if I have an order which includes freight and insurance, CIF, I have to come down to FOB value for that. Ideal period for the packing grade would be the normal business cycle, and this would differ from exporter to exporter, business to business, commodity to commodity. 360 days from 14/11 disbursement till 31st of March, this has been made to 450 days. It will depend, but this is the last date. Within these days, it should be adjusted. Packing rate should be adjusted ideally by submission of bill. So bank would allow post-shipment on that bill and adjust the pre-shipment value. If it is not adjusted on 360 days or 450 days, then it is known to be or taken as a default adjustment from local funds. And from day one, the tag relating to export finance is withdrawn. Now, what does it mean? Any concessional benefits given as an export finance are withdrawn now. It becomes a domestic finance in default. And even if interest subvention has been availed by the exporter, that will be recovered by the bank and repaid to the government. I just thought of doing a simple exercise that if I have a repo rate of 9.25 today and my normal rate is 9.25, the subvention of 2.75 is allowed to me, then my rate up to that due date becomes 9.25 minus 2.75. 6.75. And from after that due date, the next rate, the old due rate could be 9.25 plus 2, 11.25. Subvention is not allowed there. So the pricing change 6.75 and 11.25 straight away. Now, if I do not repay or if I do not adjust in 360, 450 days, then banks may charge a default penal interest of 2 to 4% beyond this 2% of overdue percent. And that may lead to local funds of 13.25 or 15.25. And the sanction which I was reading today morning had a default interest of 18% on all defaults. Straight away, all defaults 18%, even if the interest is not serviced. Exporters with good track record, who have got 3, 4, 5 years of experience, and then maybe they are in SCZ, etc., are allowed to avail the packing rate without lodgement of order. But that order is to be submitted within a reasonable period of 30 days. Some of you might not be exporting directly. You may be supplying the material to the exporter who is a merchant exporter. So even those sub-suppliers are allowed to take the export finance, provided the main export order holder, the merchant exporter, gives a disclaimer in favor of sub-supplier. Sometimes the goods do not leave the country, but we categorize them as an export. Supply under advance authorization, supply of machinery under EPCG, supply under some government project or World Bank finance project, etc., where the realization of the payment either is in rupees or in free foreign. Both are allowed. But finance for deemed export can be categorized under the export finance guideline. Pre-shipment credit in foreign currency, where the benchmark rate for interest moves from repo rate to SOFR, secured overnight funding rate. You have an order in dollar, you can take in euro. And the rate would be SOFR. What is SOFR now? SOFR 90 days is roughly 3.63, and maybe the normal rate could be 5.63, 2% markup, and subvention is not there in foreign currency. Subvention is only there when you draw in rupees. Pre-shipment, if I have a domestic input requirement, then it has to be converted at current rate only. But if I have an import requirement, then I can remit those funds drawn under packing rate in foreign currency directly to the foreign supplier or retirement of foreign bill, etc. Now, when the foreign currency loan is given by the bank, they also run this foreign exchange risk. If you do not pay, then what happens? Or if you are not able to ship the goods, if the bill is not realized, etc., then that liability is dealing on the 30th day from due date adds to your cost. We move to post-shipment credit now. Post-shipment credit is where the bills are purchased ideally. Bills drawn in foreign currency are purchased, so application of foreign currency rate is there. If it is a side bill, then today's rate is okay. But if it is a usance bill, then you have to see whether that usance period premium is added to that rate or not. Always cross-check. And you have to calculate a due date, so from today to due date, interest is recovered upfront. Different nomenclatures are there. For side bills, we call it foreign bill purchased. Some banks may say foreign bills purchased or export bill purchased or EBP, XBP, anything like that. If it is a usance bill, then discounted bill. And if it is an LC bill, then we use the word negotiation. Negotiation of bill. You have to calculate the due date for each bill. If it is a foreign currency bill drawn, this is the FEDI rule, standard rule, all banks will adopt in the same manner. Normal transit period for a side bill drawn in foreign currency, 25 days from the date of purchase. If it is a rupee bill, 20 days from the date of purchase. If it is an LC bill, then 5 days if it is a reimbursement clause. In case of usance bill, if it is a 90 days usance, means 90 days credit is to be given to the buyer from the date he accepts, and I do not know when he will accept. So I will add 25 days plus 90 days, and maximum up to 365 days I can allow. Or it could be a fixed date, 90 days from shipment date, 90 days from bill of exchange date. So I know a date. So from that date I will allow 90. This due date is linked to concessional interest rate. I will get the concessional interest rate or subvention up to this date only, not beyond that. So I have to take care of these dates to avoid payment of overdue interest and save on penal interest. That 2% additional. So if my bill is due, say on 30th of September, already discounted bill, I should maybe get in touch with my buyer maybe on 15th and remind him, you have a bill which is due on 30th September, don't delay it. Otherwise, I'll have to pay more interest to the bank. You pay on 29th, no problem. You pay on 1st of October, no problem. But don't delay by 15 days. It will change the calculation for your each bill. Couple of more tools. Factoring is the new baby on the block. Now, government has also put in a push to maybe promote factoring. So factoring is another method to finance, and there are separate factoring companies. In India, factoring started in 1999, and we also had an act in 2011. What they do? They are discounting the bills, non-LC. They will set the limits. They will do debt collections. They will send reminders on your behalf. All functions they do, not only the financing. And currently, we have SBI factors, Can Bank factors, Grip Capital, India factors, India Exim factors in GIFT City, and several others who are operating from Singapore or from GIFT City. Financing is an essential function. They normally will discount your bill and give you 80% or 85% of the value. Some cases 90 also. And balance is paid when the buyer pays after deducting the interest cost, etc. They will pay the balance. What will they do? First, the factoring company will do an assessment of the exporter and then set a limit. If you have a turnover of 50 crore, if you have a turnover of 20 crore, they may say we will give you a factoring limit of 10 crore or maybe $1 million. Then they will ask you for top 3 or 4 buyers to whom you are doing more than 20% of your exports. Major buyers. They will do a financial check on them through their counterparts in those countries. And then they will come back and tell you, sir, we have seen all these ABCD buyers. We will give you a limit of $2 lakh on buyer A, 3 lakh on buyer B, 2 lakh on buyer C, 1 lakh on buyer D, etc. Total limit 1 million for you, but sub limits for your buyers. This gives me an indication of the credit risk which I will have on a buyer. I should not go beyond 2 lakh, 3 lakh, whatever limit is there. They will finance the bills drawn on the importer, get it accepted, pay you 80% here and 20% only when it is paid by the buyer. And this 80% is covered under insurance if it is non-recourse, without recourse. They will do the follow-up with the buyer, they will take the insurance claim, etc. You get only your balance 20% minus charges if the buyer pays the full amount. Then LC is also one of the tools where you can get additional money by getting the LC discounted or negotiated from a bank if it is from a good bank. The condition is good bank. The bank which is acceptable to your bank. So larger banks will have lines sanctioned to maybe 100, 200, 300 banks across 30, 40, 50 countries. The risk is taken on the LC issuing bank, so I do not require a limit here. And normally the bank will send the document of collection. Once the acceptance is received, they will block those lines and give you the money. Some points to take care. I must know that LC issuing bank is acceptable to my bank. So whenever I am fixing the contract, at that time only I should ask which bank is being used to issue the LC, and I must check with my bank. Get this check before the LC is issued. After that, it will be difficult for the buyer to change it. Get a draft LC, check all the conditions with the contract, and maybe even with your bank, you can check it. Of error-free documents is more important because your slight error, the documents go out of LC. The bank can back out and see that your bank is negotiating without recourse. The issues are that people are not aware of this tool to use it. Maybe LC is not put in. We always think that every time we want advance 100%, but LC is also a good instrument. I must focus on LC issuing bank and also the buyer. My maybe credit risk is on the buyer, but LC issuing bank is also important. And I must learn error-free preparation of error-free documents because even spelling mistake could take the transaction to other side. Interest subvention scheme was introduced in January. Subsequently, another announcement was there. So we currently have this 2.75% of the interest subvention for MSME units, where there is a cap of 50 lakhs per financial year. Available to manufacturer, non-merchant exporters also, but not for deemed exports. There is a positive list of HSN 6-digit tariffs. So you have to go what HSN you are using there. Any advance taken from the bank after 2nd of January is covered here. Even if I have a limit which is sanctioned last year, but advance taken subsequent to it, because it is a drawing separately. If I am dealing with what I have to do, I have to generate a UN at DGFT site. If I am dealing with more than one bank, then I have to generate multiple UINs. This limit monitoring of 50 lakhs is the sole responsibility of the beneficiary or the exporter. Under the Niryat Protsahan Export Promotion Mission, this subvention scheme has been extended to those entities which are approved by RBI and the IFSCA at GIFT City for factoring related expertise, alternate method of financing. Here also 2.75 is available for financing, which is allowed by RBI approved factors and IFSC regulated agencies. The scheme is in place. The factoring agencies are required to register themselves on the DGFT site, and exporters are also required to generate a separate UIN for factoring. But I have not yet received a confirmation whether this is live now. Because just 2 days back, also one of the factoring companies told me, sir, we understand even the technology, this upgradation has not been done, and they are working on it. So you'll be able to claim from maybe 2nd of January or 20th of February. But as of now, if anybody is claiming subvention on factoring, please drop me a message 1-to-1 because I also need to upgrade and know what changes have been made there. So this is all from my side. In almost everywhere we have seen that wherever we know how to calculate interest, how to save on interest, etc., it is the beginning of the wealth. Thank you very much. These are my details. I will also post in the chat for you to interact with me subsequently. Drop me a WhatsApp on this number for any of your requirement, anything relating to compliance on RBI side or maybe credit side you want to understand. Thank you very much, and happy export.
Thank you, Gaurang ji. We will take question and answer session once Malini finishes her presentation.
Yes,
so I request Rakesh to upload the presentation. Malini, over to you.
Thank you, sir. Good evening, all.
Yeah, is PPT visible?
Yes, it's visible.
Yeah,
Good evening. So my name is Malini. I'm from ICICI Bank, and I am here to give details about the trade proposition that we have in terms of digital solutions from ICICI Bank. So a lot of importers, exporters are generally faced with challenges, which is about how to reach the branch on time to get the outward and inward remittances settled, or whom should I approach, which branch should I approach, who's going to help me with my compliances. These are very, very common queries, which is most of our customers might be having. And we have a one-stop digital solution which will give you answers for all your queries. You can go to the next slide, please. So we have a trade online platform which is specifically designed for our importers and exporters. This is a one-stop solution for all your import and export transactions. There is a specific turnaround time. In fact, it's a quick turnaround time for all your routine transactions. Your outward remittances could be done in 5 hours. Inward remittances could be settled within 3 hours. Your bank guarantees, your LCs, all these requests can be done through the trade online portal. We also have some innovative features, like we have the instant EPC facility, which has been provided through Trade Online. You can also go for the LC draft, instant LC draft generation, the smart bank guarantee, and you also have a full value outward or a full value inward remittance that can be done through the Trade Online. In addition to this, we also provide the capital account services, where you would get support for all your firms, your filing of your FCGPR and other regulatory compliances in the firm's portal. We also provide the best custodial services which is required. And we also have Trade Emerge, which is something new that we have added in our Trade Online portal, specifically for our new importers and exporters, where you will get all information about the regulatory guidelines and about any other compliance requirements pertaining to your import-export transactions. Go to the next slide, please. Right. So like I said, Trade Online, you can use it for all your transactions. You can do the lodgement of your shipping bills. You can settle the inward remittances. You can do the lodgement of the export collection bills. And also requirement of bank guarantee or LC can be done through the Trade Online portal. You can do your import payments, your service payments, and also your LCs and your collection bills. Now in Trade Online, it's a part of corporate internet banking. There's no additional setup cost which is required to set up your Trade Online. Through Trade Online, you can transact paperless. In fact, you only have to upload the documents. So at any point of time, you always have an audit trail of all your documents whenever you require them. And like I said, it's a quick turnaround time. And of course, the best thing is it's available around the clock. You can go to the next slide, please. So the unique features, like I said, one is the quick turnaround time. We also have, to save your time, you can use the pre-filled templates. So a lot of our importers, if they are making payments to the same overseas party, and you could make use of these pre-filled templates to save your time. You could also schedule your transactions according to your due dates, which is there. All your compliance pendency, like your bill regularization, everything can be done through the Trade Online portal. In fact, in certain cases where you would want to give your accounts team access only for the regulatory compliance, we have that provision where you can give only view access to your accounts team, and they can take care of the compliances through the login. We also have alert facility, customized alerts, where in addition to the registered email ID and the registered mobile number, you can give up to 5 more additional email IDs and mobile alerts, so that the people from your accounts team could also get details about the inward and outward remittances, the alerts and the SWIFT messages. Okay, so the no account view is a unique feature. Also, for first time users, we have a virtual guidance, not only for first time. So whenever you're doing a transaction, whenever you are facing any issue, you will be provided virtual guidance, which will give you a step-by-step process about how to do your outward remittances or settle your inwards. We also have a master vault facility, which is created in each of the Trade Online for the users, where they can save important documents, like maybe your LEI, your IC, or maybe your LOA, or certain documents which are required for your regular transactions. These can be saved in the master vault. So it will again save your time, and then it is easily accessible. We have the online deal booking, which can be done through our FX Online portal. We also have an Instabase. Now, this is specifically for the directors and the owners who are probably constantly traveling, and whenever they need to approve a transaction, they can do it through their through the iMobile app, which is called the Instabase. You can go to the next slide, please. This is a one view dashboard which we have provided in the Trade Online platform. This is a one screen where you would be able to see all your transactions, what is pending with the bank, what is pending with your team, what are the LC due dates, what are the due dates of your bank guarantees. So this is a one view dashboard, complete dashboard for all your trade related transactions. In fact, this screen would also give you details about your export bills which are pending for regularization, your import bills also, where bill of entry submission needs to be done. So this screen will enable you to also check your EPC and PCFC due dates, your LC due dates, your bank guarantee due dates. So it will be easier for you to monitor all this. So we'll go to the next slide, please. The innovative product, like I said, for our exporters, we have the Insta EPC facility. So this facility is only available for those customers who have a running order, and there should not be any export order which is outstanding more than 30 days. And also the LEI needs to be updated. These customers, if they have all these conditions are taken care of, they can avail the Insta EPC facility through the Trade Online. The next slide. Again, customers generally face a challenge in terms of bank guarantee, because it is a very critical time critical activity where they have to make sure that the bank guarantee is given within the specific time. So in such cases, the customer can raise the request through Trade Online portal itself. Okay, so it would be like a one-time initiation of the request, and he can select the branch where he has to collect it. If there are no on-risk clauses, then we would be able to print and provide the bank guarantee within 3 hours. We also have a bank guarantee text which is available. So customers who do not have bank guarantee text available, they can use this as a reference to get the bank guarantee generated. You can go to the next slide. Trade Emerge. Trade Emerge is a unique facility. This is specifically designed for the new exporters and importers. Obviously, as was discussed in the presentation, the MSMEs, they are the most important contributors in terms of for our Indian economy. So there are a lot of new budding exporters, importers, and they would want to know what are the regulatory guidelines, and also how do I get started in the importer-exporter business. So you can always use this application in our Trade Online. So this will give you details about how to get started. So what are the licenses required? So you can directly go to the portal, and this will take you to the DGFT portal wherever you have to get the licenses, wherever you have to apply for the licenses. Again, it will also help you to discover the overseas buyers and sellers. So we have a tie-up with around nearly 3 lakh overseas buyers. Through this portal, you can get in contact with them. You can also get the DNB reports and the other credit reports of the overseas parties, for which there would be a charge. Of course, as ICICI Bank customers, there would be the rate would be lower. This facility can be availed through Trade Emerge. In addition to this, like I said, all the regulatory compliance requirements, you would be able to access these guidelines through the Trade Emerge portal. You can also discover your logistics partner. So we have a tie-up with certain logistics service providers who can use that facility and find who is the best logistics service provider as per your cost, and you can use that. And of course, we also have the insurance facility, which is available through ICICI Lombard. So all this will be available through the Trade Emerge portal. So all this is the trade online details that I was talking about. One is no setup cost, and it's absolutely free of cost. It's a quick turnaround time, and we also have this LC. In fact, for non-customers also, they can use the LC facility, which is available for non-customers. They can try this, and also for through the firm's portal, if they have to do any reporting, we can also assist non-customers. So you can always log in and check, and we should be able to assist you. Any other information about trade online or any of our banking products, please do get in touch with us. We would be happy to assist you with all your banking requirements. Thank you.
Thank you. Thank you, Malini. Now I
Thank
request Gaurang ji, if you could just open the chat box and answer the queries.
Yes, sir.
Yeah. Bangladesh.
So there's one question by Mr. Sunil Manohar. Would you suggest how to get funding against export business with Bangladesh customers, as many of the banks are reluctant to fund against Bangladesh? So Bangladesh is a different type of problem, sir. And there maybe even the LCs are not honored in time. So maybe if you have a sanctioned limit with a bank, then on a clean side, bank may give it on recourse basis only. Even discounting of LCs are also done on recourse basis. In certain countries, it is very difficult that even the LCs are not honored. And every time, if the payment is not made on due date, then somebody has to push, or the exporter has to push through the banking system or through other means to get the payment, maybe delayed also. This is one aspect you have to discuss with your bank, that how they can finance within the sanctioned limit, but it will always be on a recourse basis. They would not do on anything on a non-recourse basis, discounting, etc. So the limits will have to be set up first for that.
So we have sanctioned limit, but even after this requesting for ad confirmation, they are reluctant. They are not willing to discount.
Confirmation is no question right now, sir, because confirmation is only done by the banks when they are sure that the other bank will make payment in time. So confirmation at even higher, it is only a thing that maybe if some bank has a branch abroad in Bangladesh, and if the LC is received from that branch to this bank, then because it is the same company or same bank, then it could be maybe add the confirmation also. Otherwise, they would not. More likely that they would not do it.
Okay, thank you, sir.
Any questions? Any participant? Please unmute and ask the question.
One hand raise is there, sir, by Salil Chawla.
Yeah, Mr. Salil Chawla, please unmute.
Thanks for the opportunity as ever, and good afternoon to everybody. Sir, I have to say, last time also I had attended it very audaciously, and I have to say that ये तो आप गागर में सागर भरते हैं, sir. Thanks to being so explicit, so patient, and so elaborative, I think trade tends to gain a lot. A very quick question I want to ask is that now, since we are amid the war condition, till yesterday it was looking like that war conditions are abating, but last night again, US heavy attack on Iran, again hot blow, hot cold situation. It is refusing to die down. Anyways, that is externality. Nobody has the control. Now, given that MSMEs, as Dr. Siddhartha ji also said in the outset, in the opening remarks, that around 70 to 75% exports emanates out of MSMEs. So in these war conditions, do we have got any special credit line or any facility, apart from the conventional traditional policies they have got, especially to West Asia, where approximately, if I'm not mistaken, 20-25% of India's exports comes, and given that we were trying to ripe for these West Asia different FTAs also, which April onwards should have come into force, but unfortunately again war is like a China wall, it has come in between. So kindly give your take. Thank you once again.
Sir, considering the war conditions or those internet, maybe cross-border issues which we are facing, and we very rightly said that we were just thinking that it would taper down, 60 days should happen, and then it will come to 4. But before 60 days, I think 17th June, this OFAC condition was issued for 60 days, and yesterday night it was invoked or maybe withdrawn. So the government had issued a guideline on relief measures, where in case of already shipments which had happened in February, March, and then March to June in West Asia, where the payments have not come in, so ECGC has been roped into. For earlier, there were, I think, 9 or 10 countries, 2 more countries. Jordan was also added. That specific permission is there. Also, there is a track 3 under that relief measure, where even if you do not have an ECGC policy, either prior one or subsequent one, track 1 or track 2, then also your increase in cost of shipment insurance could be covered there. And I was just going through the ECGC website yesterday night, where it said that 470 odd crores of total budgetary support was announced, and till now the utilization is almost half. 260 to 70 crores have only been utilized. So there is a scope to raise your claim if your shipments to any of those 11 countries is there between firstly between 16th February to 15th March, and secondly between 15th March to 30th June. This is one. The additional funding requirement of that 20% which has been allowed under the guarantee. If you are already availing a limit and then require money, and your bank is reluctant to give because of the collaterals or other parameters, then under the government guarantee, additional 20% can be released. You have to just go back and check whether that scheme is there, and the banks must take care of that, and up to 100% of that. 20% of your limit can be covered, and additional funds can be released during this times of stress, because this will, in this period, what will happen? More stocks will be there, and for holding of that stock, you will require more money. Not aware of any other scheme additionally announced by the government for financing during this war time, particularly in this Middle East area, etc. But gradually, I think releasing the money will not only solve the problem. The problem will be that how we will be able to get demand from those countries, and then maybe ship goods to those countries. That is more important now, on which I think the machinery will be working.
Many thanks, sir. Thank you so much.
Any questions? Anybody? Please unmute.
Hello.
Yes. Yes, Mr. Dinesh.
Yes, I want to ask that Exim banks are not providing finance to merchant exporters. They told me that we provide finance to only manufacturers. So how can merchant exports get finance?
From the banking system. There are banks, there are MFIs who are giving finance to merchant export.
Okay.
Exim Bank has a scheme where they finance the composite unit as a whole. So they will only not look at working capital or not look at bill financing. They will look at the entire unit as a whole. And largely they are currently under this current scheme, they are providing support to the banks also. But direct financing from the banks for merchant exporters is possible. You can get in touch with some of the banks, and if you have a past track, past balance sheet, past experience, etc., then maybe both under CGT MSE or otherwise you can get it done.
Thank you, sir.
Any questions? Anybody?
Sir, this is Amit Khanna here.
Yeah, Mr. Amit.
I actually lost your system for a few minutes. I was just wondering, is there any policy that the government is asking, especially when we have all the bankruptcies in the US? We faced 2 bankruptcies. Unfortunately, the people who want to trade from there do not guarantee any kind of funds to exporters here. And that is a very big problem. And how does the community look here?
So I'm not exactly aware of the details of the bankruptcies that you're talking. My take here would be that when the weather is rough, everybody should go in for a credit insurance to take care of the other side of that, because we are sitting here, we never know what is happening in Egypt or what is happening in US or what is happening in Europe also. So credit insurance is the best thing. It adds to your cost by 1.5%, 2%, maybe less than 1% also in certain cases. But it gives you a security of your percentage of margin, because your percentage of your exposure to the buyer. Another thing, ECGC or the similar ones who are there in the credit risk coverage, they will keep a watch on the buyer through their counterparts. As an exporter, each exporter cannot keep a watch on the buyer. So my take would be that when the weather is rough, always carry an umbrella. Maybe in Mumbai, heavy rains would be there, umbrella would not be useful. You'll have to have an additional gear. But at least ECGC cover or any insurance. Maybe there are private sector, private insurance companies also, they are also offering the credit insurance on exports. Or factoring is the other way around. If you are able to get a factoring, it increases to your cost, but it adds security to your overall portfolio if you are able to get it.
So when you talk about ECGC, they have a very fine line that they say that if somebody were to file a bankruptcy in the US, then even if that particular exporter is covered here, it stands to be honored the day it is filed over there.
Maybe we'll have to read the fine print of the ECG cover also in that case.
Yeah, because I think that
normally what I understand basically that there's specific policy or whole turnover policies are there for exporters that it covers the word bankruptcy.
It covers bankruptcies, but provided the goods have reached there. If the goods have not reached there, they have not been shipped out from India. It is still in, say, production state, or it has just reached the port, or it's just been on a vessel for 2 days, and they file for a bankruptcy. Then that is a very big problem for exporters here.
Oh, so sir, if the goods are still in your charge, then
the
buyer default will not work.
They technically are not in our charge
so
at
the
that
buyer
point
default
of time.
will not work if the goods are still in your charge. Then we have to take care of other means, that how we are able to sell it to some other party or find an alternate buyer, find an alternate buyer in the same country or different country, etc.
So there is one other thing. When I started my career about 30 years ago, there was a blanket thing where everything was to be exported through a letter of credit or documents through bank. Today, we are getting certain information from various sources saying that, okay, we should be taking care of it. But we don't see any effort from the government side whereby which they are trying to put in regulations saying that how do we safeguard, because if there is a small exporter here and there is an equally smaller importer in the US who does not get covered under a factoring, and they all insist on open credit these days. So if we are talking about letter of credits or advances, those are kind of things that are not really workable. And the practical aspect is that people are facing very big problems here. And there have been massive bankruptcies. There is one exporter in Jodhpur who had actually committed a suicide. We don't see any effort that the government is doing on that end.
I think anything which is required or which is to be suggested to the government can be taken up through the export promotion bodies. Maybe you are a member of TEXPROCIL or otherwise you can write to your export promotion body, and then maybe they can examine and then take up the suitable forum. Definitely, there are a lot of things where maybe which could come as a support to exporters. We are targeting what 1,000 billion of exports by 2030 in goods itself. Another 1,000 billion in your services.
Because
we may require more of the proactive policies, and I think the user is the best person to suggest the things.
Absolutely, you are absolutely right. But also the associations like TEXPROCIL and the other associations also should kind of look at what used to be 30 years ago and try and have some kind of a regulation whereby which we do not become, say, financing arms of retailers or importers in any country for that matter.
Yeah, Amitji, we took the note of it. Amitji, it would be great if you could send us a representation on this. We will take it up with Ministry of Finance and related allied ministries through Department of Commerce and Ministry of Textiles. So, Ramita, can you just put it my email ID so that he can send a representation to us? And I think, Gaurangji, we can conclude this session. But before this conclusion, I just request Rakesh to represent some slides. I have some announcement to say. So, Rakesh, please share the slides. Yeah, friends, we have some forthcoming webinars in this month. There is one more webinar which is on how to export textiles through Indian Post. It is on 22nd of July at 2:30. So request all of you to please join this webinar. Then there is one more webinar on understanding of custom audit provisions, which is very important topic. It's scheduled on 30th of July 2026 at 2:30. So request all of you to please register for these webinars. We already issued the calendar for these webinars, and separate circular will be also issued to these topics. Next slide, Rakesh. Yeah, this is regarding our international course, which is on international trade, advanced certification program in international trade. Our first batch is already successfully enrolled. There are 45 plus students they have registered here, and the batch is in running, and it will be end on 24th of July. And second batch is enrollment is already started. So I request all of you to please register for this course. And this will start from September 2026. There is one more course which we are planning to introduce. It's on role of artificial intelligence in textile exports, which will start from 25th and 26th of August. We will issue the circular today. And there is one more announcement I just wanted to tell you about the free trade agreement India-UK CETA, which will be implemented from 15th of July 2026. So all of you I request all exporters to go through the gazette notifications which we have already issued to the member exporters. There is one more. There are queries related to the shipments which are in transit, and which these shipments will reach to UK port on 16th of July. So there is a provision for exporters to apply for certificate of origin on Trade eConnect platform after 15th of July. They can select the option retrospective certificate of origin and take the benefit. I mean, they can inform to their UK buyer, and the UK buyer can claim the refund of their the duties. So this is what from our side. Thank you so much, Gaurangji, for this wonderful presentation. Thanks a lot for participating. Thank you. Thanks.
Gaurangji, is it possible for us to have your contact details?
Sir, yeah, I have posted in chat, sir.
You already posted?
In chat.
Amiji, you can take down ded@texprocil.org.
That I've taken.
Yeah, you wanted Mr. Gaurang's email ID, right?
Right.
Yeah, जरा post कर दो ना. मैं डाल दिया, ठीक है. Okay. Thank you, Amit ji. Thanks, Gaurang ji. Thanks.
Thank you so much, sir.